Hello, SCCWMS 5K walkers, and hello to all of you who are visiting with us on this blessed Saturday. I am Shirley Longmore, Chair of the Financial Health Team. Other members of the team are Angela Adams of First AME Church, Los Angeles, Cheryl Baylark of Grant AME Church, Los Angeles, Lynn Odrick of Christ Our Redeemer AME Church, Irvine, and Pamela Pitcher of New Philadelphia AME Church in Long Beach. And I am a member of Rose of Sharon AME Church in Norwalk. What is your big, hairy, audacious goal for 2022 and beyond? Is it to get your financial in order? Well, we are here to give you some valuable tips. Our presenter, Cheryl Baylark, has over 6 years of experience helping individuals and families achieve their financial goals. For the next few minutes, she will share some valuable information with you on the subject of the 3 financial enemies: inflation, taxes, and risk. At the end of this presentation, contact information will be shared. We hope this will be the answer you have been waiting for. And now I present to you Cheryl Baylark.
Thank you, Shirley Longmore. When we're talking about our health and wellness, we talk about our spiritual health, our physical health, and our mental health. We seldom think about our financial health. Anytime we experience financial problems, it causes stress. Stress leads to headaches, body aches, and many other symptoms. For a few minutes, I'm going to share information with you that can help you understand basic money concepts that affect how we save and grow our money. I'm going to share my screen. And as Shirley mentioned, the topics I'm going to talk about is inflation, taxes, and risk. Inflation. Inflation is the cost of goods and services sold. Inflation generally increases 3.2 to 3.4 every year. Why that figure is important? Because wherever you have your money, you want to make sure it's outpacing inflation. Therefore, if it's not outpacing inflation, you're working for your money and your money's not working for you. When we talk about savings, we have to talk about interest. And there are 2 types of interest. There's the simple interest, which is the principal plus the interest. And then there's the compound interest, which is the principal plus the interest that doubles. So when we're talking about the simple interest, the principal and the interest, say for instance, on your first year, you're saving $10,000, right? And so you have 10% interest. So you're going to get $1,000 on that 10,000, which is going to make 11,000. And that next year you get another 1,000, which will make it 12,000 and down. When we talk about our compounding interest, we start off with the same principal, but it's the principal and the interest that's compounding together. So that same $10,000 plus 1,000, the first year it's 11,000, but that second year is 12,100. That third year is 13,310, as you see that it doubles. So to get a better look side by side, you can see the first year remains the same. And then each year, when you look at the simple, at 2 years, you have 1,200, and then you have 1,210. At 10 years, you have 2,000, and you have 2,593.74. But check it out. If you go down here at 50 years, you have 6,000, simple. Here, compound interest is 117,390.85. So when we're talking about putting someplace where we want our money, the simple interest is more or less paying on a mortgage. The compound interest you want to put somewhere where your money is compounding. And then when we talk about compound, we talk about the power of compound interest, such as the rule of 72, which they say is the eighth wonders of the world, which was established by Einstein. And what that is the numbers of years to double an investment by dividing 72 by the rate of return. So if you look over here in this first box, if you have your money someplace earning 4%, 72 divided by 4 is 18. Therefore, your money is going to double every 18 years. So at age 34, you're starting at 10,000. At age 70, you're going to have 40,000. So say your money is somewhere earning 6%. 72 divided by 6 is 12. So therefore, your money is going to double every 12 years. So that same 10,000 at age 34, at age 70, you're going to have 80,000. 8%, 72 divided by 8, every 9 years. That same 10,000 at 34, at 70, you're going to have 160,000. And then 10%, 72 divided by 10, 7. So every 7 years, your money is going to double. That same at age 34, the 10,000 investment. At age 70, it's 320,000. So compounding interest is very important to know and understand because that is the key to saving and growing our money. So then the other thing we're going to talk about is taxes. Now, let's face it, we're not going to get away from paying taxes, but what we can do is reduce the taxes that we pay by understanding how we pay our taxes. Now, when it comes to taxes, when you earn it, it's called income tax. When you spend it, it's sales tax. And when you save it, it's capital gains tax. And when you die, it's estate tax. And there are 3 timings of paying taxes. The first one is tax now, and that's when you pay your taxes within the first year. And generally, those are deductions from your payroll check, your CDs, your interest on your CDs, your saving, your money market, your mutual funds, stocks, and real estate. And then there's a tax later, a tax deferred. So in this category is where many of our retirement plans are. IRS coded retirement plans, such as the 401k, 403b, IRA, SEP IRA, and annuity. And what many people don't understand about this account sometimes is that they take the money out and they hold it for you. And so, yes, your money is growing, but when it comes time to take that money out for your retirement, you haven't paid the taxes on it. And so taxes are going to go up. And so the purpose of calculation, if taxes are 50% and say you're expecting 600,000 from retirement, you're only going to get half of that amount because you haven't paid the taxes on it. And for a lot of people, they don't understand that, or they didn't understand that when they started their retirement plan. And many people have had to come out of retirement and go back to work because they didn't have enough money. And the other thing about these retirement plan accounts, they're part of the stock market. So high potential gains, but also high potential loss. So if you're not paying attention to your statement, you could be losing money. And a perfect example was January 2020 when the market dropped. A lot of people lost money when the market dropped. And many people were getting ready to retire. And when you're getting ready to retire, you don't have time to make that money over. So when you're in these accounts, pay close attention to them, read the statements. And then there's the tax advantage account. And these are after-tax dollars, okay? Over in the tax now, when you pay your after-tax dollars. And you can put money in these particular accounts. A Roth IRA, a 529 college plan, and believe it or not, cash value life insurance. Life insurance has changed over the years, and life insurance has many functions. Life insurance where you can put your money and it can accumulate compounding. Life insurance also offers living benefits. So if you should get sick with a stroke, heart attack, cancer, renal failure, and other illnesses, you can take a part of that policy, that death benefit, and help offset your expenses while you're recuperating from your illness. So I always ask, would you rather be taxed on the harvest, which is in the tax deferred, or on the seed, with after-tax money where you put it into these tax advantage accounts and the money keeps growing and growing and you won't be taxed again. And if it's structured properly, you can use it for retirement. You can use it for college planning. There's a lot of functions. There's over 10 functions of life insurance that people aren't even aware of. So do you have the old insurance or do you have the new insurance? And so it's here, where would you want to put your money? Of course, I will put my money in the tax advantage so that I can grow my money compounding. And then there's the risk, the stock market or the roller coaster ride. Now, don't get me wrong, the stock market is good. And if you have enough money to ride that market, good, by all means do so. Good, by all means do so. So when we talk about the stock market, of course, we say again, it's high potential gains and high potential loss. So here we are, if your starting balance is at 10,000 and the market drops 50%, you're at $5,000, right? So then you're going to take that 5,000 and you're going to write it the second year and say the market's up 100%. Yay, we're all exciting, right? But guess what? It's only going to go to your original investment. And that original investment of 10,000, that third year, say it goes up 100%, then that investment doubles to 20,000. However, say that fourth year, it drops 50%, and then your investment is going to drop down to $10,000. Now, many times you hear people say, you got to ride the market, it's only on paper. Well, that's not true. You have to make sure you understand the market, because especially if it's part of your retirement plan, you can't afford to lose any money. So there are other options out there for your retirement where you can participate with the gains of the market, but not participate with the loss of the market. And of course, we'll be more than happy to share that information with you. So in conclusion, the information I'm sharing with you is information just to kind of open your eyes, to give you options, to let you know what's out there, and to kind of wake you up. So if you would like more information, please contact us at the email address bhagfinancialteam1@gmail.com, and we'll be more than happy to answer any of your questions. Thank you for allowing us with this presentation, and you have a blessed and joyful day in the Lord.
Amen. Thank you, Shirley Longmore.